James Bevan is the Chief Investment Officer at CCLA. It specialises in managing money for charities and churches. Among their biggest clients, the Church of England. That's quite a responsibility, James. So what are you doing with their money?
Well, I believe very much that the quality end of the equities market, particularly the big caps, still look very cheap. We have a risk premium on forward-looking estimates of about 5.5%. I think 4.5% is probably the number we need to see. Therefore, I see considerable upside for the equity markets, at least in the near term.
So we're seeing having a bit of a gut check right now, but we did have the FTSE at an 18-month high a week or so ago. So you're saying we're going to be building on that. So, what specifically are you actually putting your money into?
Well, I'm talking about quality growth stocks at the big cap end. So if I were looking in the global context, looking at US companies like Apple and Amgen over here. In Europe, I'd be looking at companies like Novo Nordisk, also Imperial Tobacco, for those who are not ethically constrained.
Right. Well, of course, that's key. In your job, that's going to be key as well.
Absolutely.
So, you have to avoid certain things, don't you?
Except the ethical agenda is, of course, much more about engagement, and engagement is about good corporate governance. Good corporate governance is about better shareholder returns. So I think it's a win-win.
Right. Let's just, if you look at the FTSE 100, of course, you're taking a bet on global exposure, effectively. These are global companies, most
Absolutely
of them.
right.
So, that makes me think that you're very positive as far as the global recovery story is concerned. But what about what's going on in the US and the UK? One of our top stories this morning, Moody's Investor Service looking at those two, saying that they could lose their AAA rating.
Well, there are several different strands you bring to the table. First of all, this issue of global recovery. And, of course, a large chunk of the world has never had a material downturn and continues to major ahead. And I fully expect China to be able to enjoy growth this year around 9.5 percentage points, and therefore an unbroken string of continued good progress. And I only expect that to begin to suffer if export prices begin to rise, and not until then. In terms very particularly of the UK, actually I think that we're going to have fiscal rectitude, we're going to have a tightening of the spigot in terms of spending. That's not new news, but what I think it does mean is that we have a weaker pound and also very low interest rates for longer. And therefore I think that we will create the engine of economic recovery. In terms of the AAA, AA stuff, I think that's actually a load of nonsense in terms of whether the market should mind about this. And my reasoning is this, that the countries that get into trouble when they have a government debt crisis tend to be those that have issued in someone else's currency, and therefore when their currency plummets, their cost of servicing other people's currency debt goes up. We don't have that problem. Almost all of our debt is in the pound. I do think that we will see a materially weaker pound over the long term on a trade-weighted basis. That said, I think that's very good news for the UK economy and very good news for exporters.
Those export figures the other day, it doesn't appear that this weak sterling is actually helping this economy much.
Well, it's a slow reaction, and I think that the flip side is that we are actually going to see higher inflation. And I know that that also is taking time to come through. But if one looks at the long-term trends of currencies relative to inflation, lower currency will mean higher inflation.
What about the US in all this as well?
Well, one of the interesting issues about economies versus corporates is we keep thinking that actually markets and economies are well matched. Now, in the US, what we have seen is really very substantial cost cutting, therefore relatively high margins. And of course, the pair, if you like, for this has been the employment numbers, which have been truly awful going through this so-called recovery. But it does mean that I think the companies will come to the table with much better than expected earnings results. And I fully see scope for US earnings to be much better overall, and in particular circumstances, really extraordinarily much better.
Right. We look at both the US and the UK, they do share this whole thing where property prices in the US, they've plummeted. We saw an actual recovery take place here in the UK, but figures suggesting, well, the moment is turning against it. Could we have a double dip in the housing market, and what would that do to you as an investor?
Well, I certainly think that over the long run, UK housing has to correct downwards, and obviously it hasn't because we've had very low interest rates. So the cost of debt service has been left at a relatively low level. I think if the cost of debt service goes up in due course, then that's going to be a significant issue. And of course, all of these issues relate to the whole question of how much debt can the government issue and who's going to buy it. Now, at the moment, the banks have been principal purchasers of the UK government bond market. With very low interest rates, there's been a big carry. As and when the consumer wants to borrow more money, then I think that's really bad news for government bonds.
James, great to have you on the programme.
Thank you.
As ever, James Bevan there is the CIO, the Chief Investment Officer at CCLA.